When markets turn volatile, investors usually turn to safe havens: gold, bonds, the US dollar. But what if those don't protect your money when you need them most? As tension continues in the Middle East, gold has fallen, bond prices have dropped, and the US dollar isn't surging the way it used to.
That assumption that whenever you have a risk escalating in the markets, you rush to the safe havens, that assumption is now starting to get tested, and a more nuanced approach to safe havens is being observed in the markets.
So if the usual safe havens aren't working, what should you be doing with your money? Gold is often seen as the ultimate safe haven, but in this market, it's being pulled in different directions. Since the US and Israel launched strikes on Iran in late February to late April, gold prices have fallen about 10%. Some investors are selling to raise cash in volatile conditions. Others may be locking in gains after gold's strong run in recent months, and rising interest rates are making other assets more attractive.
Gold could not serve as the perfect safe haven because when you hold gold, you do not get any income, any dividends, any kind of an interest on that. And what that means is that investors kind of compare that if they had put the same amount of money in, say, short-term bonds, they would have gotten some yield, some interest on that. So with interest rates going higher as a result of that inflation risk, that opportunity cost of holding gold becomes higher as well.
Gold is not the only safe haven behaving differently. The US dollar is still a safe haven, but its role is changing.
Traditionally, when there's a geopolitical event that happens, investors tend to raise the dollar for liquidity. Why this time around there is a dilution, what we call the movement is not as strong as expected? Perhaps it's down to two things. One of it is already occurring, which is de-dollarization. Secondly, this could be due to the distrust between central governments around the world. We could be seeing as an example of BRICS. Emerging markets banks are now holding more gold than US treasuries.
When it comes to bonds, during past crises, investors snapped up US treasuries, pushing down yields and increasing bond prices dramatically. This time, they sold them instead.
Longer-dated bonds is generally tougher to trade in the current environment. Hence, short-term T-bills, that is a very stable option. Albeit some people may argue that it's going to have some issues trying to outrun or outgrow inflation.
So what does this mean for investors?
The best approach would be to understand the kind of risk that they are trying to hedge.
Instead of relying on one safe asset, investors are spreading their money across different roles. Start with liquidity, cash you can access immediately.
Cash is king from the perspective that during the initial phase of a panic sell-off mode, cash is a very good liquidity solution until you are able to find an alternate asset class or even go back into equities in order to hedge out that long-term inflation environment.
One of the more important buckets to have in the portfolio is the one that offers you liquidity. So now that could be US dollar, but for Singapore investors, I think even having Singapore dollars is very important because the expenses that they need to meet are in Singapore dollars, and just keeping the local currency means that they do not expose themselves to the FX risks.
Next, look for assets that can give you protection against geopolitical or inflation risks.
The second bucket that is important to have in portfolios is certainly one for insurance. Now that can be gold, that can also be, for example, a Swiss franc or maybe an energy exposure, which kind of offsets the inflation risks.
Then, growth. Investments that can still generate returns.
Even if they are quality companies, are you paying the right price for them? So certainly pivoting that equity exposure or the growth bucket of your portfolio towards more quality growth, so to say.
For investors with higher risk tolerance, alternatives can add upside, but need to be sized carefully. This is the playbook for investors. If markets drop suddenly, you need liquidity. If inflation rises, you need protection. And when the volatility is over, in the long term, you need growth. Each asset protects against a different risk. The lesson isn't that safe havens no longer work, it's that no single asset can protect you on its own. So instead of asking, what should I invest in? Ask, what risk am I trying to protect against? And then build your portfolio around those risks.